All right, let's dive in. Today, we are going to demystify one of the most critical and honestly kind of confusing parts of a tax audit report. I'm talking about Clause 16 of Form 3CD. Our whole goal here is to make this thing practical, super clear, and something you can actually use.
So let me just ask you this right off the bat. How sure are you that your profit and loss account is telling the whole story? Could there be some taxable income hiding just out of sight? Well, that's the exact problem that Clause 16 is built to solve.
So here's our game plan for this explainer. First, we'll talk about why this clause is so important in the first place. Then, we're going to break it down piece by piece. We'll get into the nitty-gritty of an auditor's toolkit, how to connect the dots with other documents, and then wrap up with the common traps and, the serious consequences of messing this up.
Okay, so first up, why does Clause 16 even matter so much? Well, because it really gets to the core, to a fundamental principle of the entire tax audit process.
The best way to think about Clause 16 is as a safety net. Seriously, its entire purpose is to catch and report certain kinds of income that, for whatever reason, didn't make it into the P&L account. These are the things that could easily slip by but are definitely on the taxman's radar. And that's really the bottom line, right? The guiding principle here is all about full disclosure. Clause 16 is there to make sure that no taxable income slips through the cracks. It's about giving the tax authorities a completely transparent picture of what really happened during the year. All right, to make this really practical, it helps to think of Clause 16 as having 5 distinct buckets. Each bucket is designed to hold a very specific type of income that you've got to report if it's not already sitting in the P&L. So here they are, our 5 buckets. This is our roadmap. We've got business profits under Section 28, then specific stuff like refunds and escalation claims. Then there's a kind of catch-all bucket, and we finish with the one that often trips people up, capital receipts. Let's dig into that first one. Okay, so subclause A. This is all about business income that's defined over in Section 28. So if you've got things like cash assistance or maybe profit from selling off a license, and it's not in the P&L, well, it goes in this bucket. And get this, it also includes the value of benefits that aren't even cash, like using a company car for personal trips. If it's a real benefit from the business, it has value and it needs to be looked at. Now, for subclause B, and I need you to pay close attention here because this is a huge point of confusion. It's the difference between admitted and claimed. We only report refunds or drawbacks that have been officially admitted as due by the government. A claim that the business just filed but hasn't been approved yet? Nope, that does not get reported here. The trigger isn't filing the claim, it's the official thumbs up from the authority. And you can probably guess what's next. The exact same logic applies to escalation claims under subclause C. The need to report it only kicks in when the claim is formally accepted during the year. Again, it's not about when you submitted the claim, it's about when it was officially accepted. If that happened, but the cash isn't in the P&L, you have to report it. This brings us to subclause E and a really common and kind of dangerous misconception. It's so easy to just think, oh, it's a capital receipt, so it's not income. But is that always true when it comes to taxes? The short answer is no. And this is where the auditor really has to put on their detective hat. It's the tax auditor's duty to go through all the capital receipts. The goal is to figure out if any of these receipts, or even just a part of them, actually has the character of taxable income. And if it does, you got it. It has to be disclosed right here. So we've talked a lot about the what, but what about the how? How do you actually verify all this stuff and feel confident in your reporting? Let's get into the practical toolkit an auditor needs. An auditor's toolkit here is really all about being thorough. It means digging into email chains and correspondence files. It means checking records even after the year has ended for proof that a claim was accepted. It means going onto government portals to cross-check details. And, super importantly, it means getting a formal management representation letter to get the company's official story on record. A great audit is all about connecting the dots. Clause 16 doesn't just float out there by itself. The information you put here has to be backed up by what you find in other documents and records. Let's make this super practical. For refunds and drawbacks, your evidence is probably sitting on a department's website or buried in a correspondence file. For those escalation claims, you need to be looking at the contracts, the accounting standard notes, maybe even board minutes. For other income, bank statements are your best friend. And for capital receipts, you'll need to see the asset sale agreements and any valuer's reports.
Okay, knowing the rules is one thing, but to stay out of trouble, you have to know where the landmines are. So let's walk through the 3 most common and most costly mistakes people make.
First up, and this is a big one, not paying attention to the client's accounting method. If your client is on a cash basis, then this whole idea of a claim being admitted doesn't matter for taxability. For them, income only hits the books when the cash actually hits their bank account. This completely changes the reporting game for Clause 16.
The second big mistake, and we've touched on this, is getting the trigger wrong. I've seen it happen where auditors report claims that have only been filed. But remember, for most businesses on the mercantile basis, the rule is crystal clear. Reporting is triggered only by that formal official acceptance from the authority during that financial year.
And finally, a really dangerous assumption: just treating every capital receipt as tax-free without doing the homework. If you don't take the time to really examine these receipts for any hidden income, you could be directly causing an underreporting of taxable income.
Look, the stakes here are pretty high. Making a mistake in Clause 16 isn't just a typo on a form. It leads directly to an incorrect calculation of the company's total taxable income. And that is exactly the kind of red flag that can get you unwanted attention, trigger a full-blown scrutiny, and end up costing a lot in interest and penalties.
So we're going to end right where we started, with that same critical question. After going through all the details of Clause 16, it's really worth asking yourself again, is that P&L truly telling the whole story? Or is there taxable income out there that needs its own special mention in the tax audit report? Thanks for checking out this explainer.